that's the beauty of what you built here, Tim, is a community of folks that, we can all help each other because we're all at a different place in that balance of too much money, not enough deals, or too many deals, not enough money.
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome everybody to today's Capital Raising Show. I'm your host, Tim Mai, and today I have a good friend, long-term friend, and amazing self-storage investor. I call him the king of self-storage because that's how I met him, was when he was teaching about self-storage years ago. Scott Meyers and his affiliated companies focus on the acquisition, development, and syndication of self-storage facilities nationwide. He currently owns and operates close to 3 million square feet of self-storage, over 14,000 units. That translates to about 180 million asset under management. And he has personally raised over $70 million for these deals. So super experience. His education organization, selfstorageinvesting.com, provides courses, tools, live events, and mentoring to help others launch their own self-storage business to enjoy a lifestyle he has coined free from tenants, toilets, and trash. We all love that. With his various companies, they fund and build 4 to 6 houses each year in Mexico by taking his family, staff, and clients on an all-expense-paid short-term mission trip. So welcome, Mr. Scott Meyers. Yay!
Hey, Tim, good to see you, and good to see everyone else here, and glad to be chatting about, my two favorite things, self-storage and money, or capital, that is. How's that?
Yeah. And man, so I think you and I met, I don't know, probably at least 10, probably more, right? Maybe 2010-ish.
Yeah. It's, we're close to, I was trying to think as well. I think it may be about 13 years or so ago.
Yeah. It's been a while.
Mm-hmm.
And every time I think about you, I was like, gosh, I should have gotten into self-storage when Scott told me years ago, because now I have an 18-year-old son that, I'm getting into this business. And guess what? The asset type I'm having him focus in on. Self-storage.
Self-storage, of course.
Yes. So I'm making up for it now through my son. And
if I can't get you, at least I get the boy. So fair enough.
Yes, definitely. So Scott, share with us, how did you get started in real estate? And then especially, how did you get started in this self-storage business?
Sure. Well, as Tim and I chatted about, and you heard, we've been investing for a number of years. Got into real estate in '93, and going way back. Started with the Carlton Sheets Home Study Program. That's how I got into this. Watch an infomercial. And I said, I want to be that guy. And so follow that model. And I know there's some folks nodding and giggling at the same time, but you know what? You follow the model and it does work. And so we bought our first house, rehabbed it, rented it out, refinanced it. So that, the Burr method before it became the Burr method. And then we bought 2 more, and 2 became 8, 8 became 16, and we got up to about 80 houses. And then decided that, we didn't really have the cash flow and the freedom that we were looking for in real estate that Carlton had talked about. And so, what's the best way to, put this thing on steroids? And so we started getting into multifamily. So we bought a number of complexes around central Indiana, and it never really got that large. We got to about 400 units in multifamily. And then realized at this point, same thing. It's just, even though you have property management companies and property managers in place, it still took a lot of our time. And so, everybody says they love running real estate if it weren't for the tenants. And so as I looked around, the landscape in real estate, it's either, if you don't like tenants, and it's either self-storage or parking lots, but you can't build a lot of value in parking lots. But you can with self-storage, much like, and even more so than multifamily. And so began looking into the asset class, bought my first one, and saw the light. When people don't pay you, you can lock them out and sell your stuff, and it is legal, sell their stuff. It is legal to do that. They can't really tear anything up. It's a metal box and a concrete slab. And so, my turn in apartments was, anywhere from $1,000 to $1,200 in lost rent and paint and carpet and everything else. And in self-storage, it's nothing. I mean, we take a blower in there, and blow it out, and it's 30 seconds and moving the next person that's waiting in line. And so, that and a number of other reasons, very recession resistant. As a matter of fact, we do better during a recession. People downsize, businesses downsize, and where we're really kind of in the trauma and transition business. When people are moving and there's trauma and transition in their lives, they need storage. And so a pandemic, we don't ever wish for a pandemic or a recession, but both of them are very good for self-storage. And then when times are good, people, have more money, they buy more stuff, and they don't have room in their house. And so they put their extra stuff in storage. And so for all those reasons, we made that the pivot, the shift, and moved away from sold all our houses and all our apartments and went 100% into self-storage. And then, I used to run the local RIA here in Indianapolis. I was the president of that, and began teaching workshops about self-storage because people wanted to know more about what we were doing, and they could see what I was doing in the market. And then met a good friend of ours in the industry, Tim knows, Paul Bauer, who books all the speakers into these events. And he said, "Hey, why don't you go out and teach about self-storage?" And I said, "That's great, because I write the checks to the people that come speak at our groups. And I think that might be a fun thing to do." And so we wrote a course, mostly so that I didn't have to go out to lunch with everybody who wanted to pick my brain, over lunch and then make me buy lunch. And it's a good way to teach people without having to take the time out. And it really just took off. There was a lot of people that wanted to hear what we had to say and how we were doing it. And that led to really launching then an education company. And Home Study Systems grew into 3-day live events, and then consulting and mentoring, and ultimately led us to partnering with a lot of our students and getting kind of back to, in a roundabout way, really combining the two businesses together. And so, the folks that we successfully launched into the business, we were then doing partnerships or wholesaling, buying projects and properties from them. And so, although I'm moving away from that education side of the business, I love teaching people about this incredible industry and taking them from 0 to 55 miles an hour. But my skill set is really taking them from 55 miles an hour to 100 miles an hour, and then partnering alongside. And so, we created a mastermind, which is really different than most masterminds, in that ours is just about deal flow. It's about community of people in self-storage, matching the capital up with the deal flow. Because along the way, like everybody on this call here, you recognize that, in commercial real estate, especially, you can do 1, maybe 2 deals, and then you run out of your own cash and you have to go find it somewhere else. And so you have to get really good at raising private equity to grow and scale. And to get to almost 3 million square feet and the level that we are takes, private equity to come alongside of us and fuel that growth. And so I'd say we've been successful at that. I think we just kind of have a knack for telling our story of one that is, we've got a lot of success. We got a great track record behind us, just operating from a place of integrity. We've never been shy about promoting the fact that we wear our spirituality on our sleeve, and we exist to go do mission trips and take people along on those. We build 6 houses a year and give them away, and we love to take people on short-term mission trips and show them what it's like to have an open hand and give back. And that is what fuels us and drives us as an organization, and one feeds the other. And so eventually I get to that place where we get to flip the script, and I'll spend 80% of my time on the mission field and 20% to doing what I love, which is self-storage. But for now, that's fueling a lot of our mission work, and also fueling our growth. And we are very excited about where we're heading right now in storage, and quite honestly, in real estate. If you're not excited about heading into this recession, you ought to be. For those that weren't, I'm looking around. I think John Jackson may be the only person older than me on this call here, and he remembers. And the others, we know what happened in 9 and 10. And I think all of us that were around at that time wish we had more private equity access to it, cash, liquid capital to layer on top of debt. We all would be sitting in a different position right now if we had more money to take advantage of the opportunities that existed during that time. And so it has been our goal since then to grow a list of private equity partners to come alongside of us, so that when we put the right opportunities in front of them, that we could transact and not have to worry where the cash comes from. And I'd say we've done a decent job of that. You can always, how much cash do you want or need? Well, it's always a little more, just a little more than I got right now. but we're in a good position that we know that the projects that'll be coming up we're already seeing coming up as a result of rising interest rates and troubled projects and challenges people have with their capital stack, that we're going to be in a pretty decent position. And over the next 3 years, certainly going to be the biggest land grab of my lifetime and my career. And this may be the one that throws us into that 80-20 where I then can sail off into the sunset, if you will, and spend more of my time on the mission field and time with the family, and then just 20% of the time managing the portfolio and hopefully getting my kids into the business like Tim does as well. Although they're not as excited just yet. It's the cash flow on self-storage is sexy, but the business itself isn't sexy enough apparently to draw my kids into it. So we'll see what happens once they figure life out. But I'm once again glad to be here to share my passion, which is real estate in general and the lifestyle that is provided for us. But we love self-storage, and the private equity side is it's just plain fun. Being able to create a relationship with folks and, show them, not sell them or persuade them, but just say, hey, here's what this offers you in a passive fashion. You don't have to take on the debt risk. You don't have to take on the credit risk or a lease up or a development risk. We do that, but you get to come along for the ride. And if you believe in what we've done and look at our track record, then, we'd love to have you come alongside of us. And that affirmation that comes from that when those folks do, believe, if they haven't invested with you in the past, and then ultimately when you send them checks on a regular basis and then cash them out at the end and you have exceeded the projections, it's just, I love it. I mean, this is, it's a great business. It's a great part of this business that I like probably more than the investing itself. I love to chase the deal. I love to raise the capital. I don't like to be anywhere close at all. I don't want to even be in the same room when people are talking about property management. I'll let somebody else handle that. But the rest of it, absolutely love. So, all right, with that, Tim, I may have gone over. I don't know how much time you wanted me to spend, but that's my background.
Yeah, that's actually perfect. And so, when you first started out, did you do smaller deals that you can just take them down yourself without having to syndicate, or did you start at syndication pretty early on?
Yeah, so we did all the houses on our own, and all of that was just organic growth. And so just buying and creating value, refinancing, and then taking that capital a little off the table, and then go on to do the next. And so we did that through all 80 houses, and then we did that for our first apartment complex. And then I brought my sister into our second apartment complex, and then we brought a handful of and when we talk about friends and family, I mean, it was true friends and family, my closest circle at that point in the apartments. And then when I did our first self-storage project, it was a conversion of a commercial property. It was a $2 million property. That's when we began to bring in, expand the circle and take it out to some other folks that we had just put it out to, and raised the capital in a 506B. I think that was 500,000. Then after that, most of our raises are anywhere from $1 million to $5 million.
Gotcha. Okay. So, with you having experience on the single family home side and then the multifamily side. So by the time you get into the self-storage and the syndications, what were some of your challenges when it comes to capital raising at that time?
Timing. It's always timing and managing that balance. In the beauty and one of the things that I love about the single asset, single entity PPMs, a syndication, a private placement, you find a deal, so you've got it, and then you model it out, and you've got the projections, and you've got something tangible that you can put in front of some folks and say, here's what it looks like. And so they can say, I'm in or I'm out. The cons to that, or the downside, is that, it usually means you're under contract and the clock has already been ticking while you model everything out. And then you've got a closing date coming up, and you hope and pray that you're going to raise all the capital in that time frame by the time you get to the end of your due diligence and your financing contingency. What I never liked about in the beginning and looking at going into a fund where you're raising, a $10 million, $25 million, $100 million fund where you raise, a whole bunch of capital, and then you get to go use that to deploy. I mean, on the good side of that is that you've got the capital available to go deploy. I for one, I never liked that side. I'm looking at the fund side because I think I've seen the temptation for syndicators, folks that are raising capital in a fund, in that now you've raised this capital, and if you don't have some deals coming down the pipeline to fulfill, and be able to make those distributions, if you've got a pref in your fund, or just continue to feed that and send that money out, it causes you, I think, to maybe make a less than optimal acquisition because, well, I've got, this doesn't really meet our criteria. It's not really what I wanted for the fund, but I get distributions coming up and I get to get another one in the pipeline. And so I'll make it up on the next one, or, this one falls a little bit short, but I'll make it up here. And I think it causes you to maybe not to make the best buying decisions. And so the syndication, the single asset, single entity side, I really enjoyed versus the fund side. But now that we've started a fund and we've got a robust pipeline, that's been helpful now to get to that place where we do have the capital available, so that if multiple deals come up, I don't have to wait because in a single, if you're raising capital one deal at a time, if you got two going at the same time, somebody may think, well, let's wait and see what the third one looks like next month. Tim's got a great pipeline, and let's say, these are great deals, and the second one was better than this first, and that one's not quite full yet. So let's see what he's got, and then it puts pressure on you. So I kind of like the single asset, single entity side. The fund side is very good. Both work very well. It's just you need to take a look at your pipeline and to be able to time the funding. So understand your business model, your activity. Do you have more money coming in than you have deals? Do you have more deals coming in than money? And then that determines the balance in which direction you're going to head. So a long-winded answer to your question, Tim, but that had been the challenge, is that getting all the capital in before I got to the finish line or the end of the due diligence with the actual deal, versus the challenge that we're at right now and having a fund is that we got to make sure that we got a healthy pipeline to match up with all the money so that we're not overpaying for our capital. Does that make sense?
Yes, it does. And I'm curious as to your decision to now have a fund. Does this current market and the opportunities that you see coming onto the market play a role in you deciding to start a fund now?
Yeah, that's an interesting question, because we started our fund November of 2021. So really before the high inflation rates and the slowdown. So we were still in the thick of things, and we started it was a smaller fund. It was a $25 million fund. We filled it up and we've deployed that capital into our deals. And so we're getting ready for fund number 2. And the goal was with my partners and I is to start a $100 million fund. And, that is during a high inflationary period where some of our deals aren't penciling out. We're doing the underwriting and looking at our cost of capital. And so we haven't made the final determination yet, but I think we're going to back that down from 100 million. Our pipeline is strong, still very strong, and we're still able to deploy capital. And I feel pretty confident that we could still raise 100 million and deploy that in a fashion that's going to work in 2023 and beyond. But I spent a lot of time going to different private equity events, talking with a whole bunch of other syndicators, sponsors, promoters. And it seems like most of the folks out there that, if they were going to start a $200 million fund, they backed it down to 100. If they were going to start 100, they backed it down to 50. And, some folks are raising institutional money and that money is still there. Other folks have a combination of, or they're only raising, retail money, which means truly friends and family. You're doing 506Cs and sending, information out to folks that don't have a relationship with you already, even though there's a lot of folks that are coming out of the stock market because the returns aren't there and it's risky right now in this interest rate environment, and with the Fed literally coming out and saying, hey, we're just going to raise rates until we break the economy. Well, that's difficult then to talk to our folks that may be new to us, even some of our existing folks, to say, yes, but self-storage does so well. Look how great we're doing even still. And look how great we did through the last recession. We've got a track record. And they're all just, like, without saying it, they're like, yeah, I get it. But you know what? I'm not so sure that we want to hop on your roller coaster and go all the way to the bottom before we go back up again, because we don't know where the bottom is. There's just that lack of confidence. If interest rates were steady at the bottom, whether meaning they're high, where we're going to go down in terms of rates. But even if we're stuck at 8%, we've been there for 6 months, I can raise capital there better, or the same as, I shouldn't say better, but the same as if they're stuck at 5% and steady, because, people, they understand what the rules are and how to play the game and what the game looks like. But now the rules are changing. The cost of capital is continuing to go down, and they've already said we're going to, implement, 2 or 3 more rate increases, which means values of real estate go down even further. And there's just enough skepticism in the market. And I can't say I blame them. My investors are just like, yeah, we're going to wait, Scott. I get it. I get everything you're saying. And I can see that you're underwriting to your cost of capital, but yeah, I'm just going to hold off. And so that's the place that we're at right now, is that we're still bullish. We got a strong pipeline. There's a couple of deals that aren't penciling out at the cost of capital. And it just means that our sellers need to be more realistic in terms of their expectations of value on the sale. but we're building the buffer in, we're building the yield in. And so we're pretty confident, but we just can't get all of our investors to be on board. And so we're scaling back just a tad.
Gotcha. Who are your avatar investors? Let's say your top three.
It's interesting. I'll start with, the unique position that I'm in, as you are as well, Tim, and perhaps some other folks here on the call as well. We've got an education business, and so we're influencers by that fashion. I've been at this for a long time. I speak at the industry trade shows. I write for Forbes magazine. And so we've got a lot of folks that know of me and kind of know, like, and trust me to begin with. And so, we've got a lot of folks that, there's that inherent trust level that they're looking around, on the internet. If self-storage is the asset class and they're looking to syndicate, they're going to find us. Chances are they're going to find us. And so I could say it's the folks that do their due diligence and know and understand, and they are looking for, somebody who's solid, a proven quantity. And typically, as we look at this, Tim, our avatar is, and no offense to anybody on the call here, but it is males, 35 to 45, that are college educated, that have experience mostly in real estate, but also in small business. Those are the folks that invest with us. So that's, those are the folks that I'd say that's probably the first bucket. The second is that because we've built this following and a whole lot of folks that have learned the business as well, we've got a lot of our folks that were either students that either invested or didn't invest, and they look at the IRRs that we're offering as a passive investor in self-storage. They're already bought in. They're sold on self-storage. They understand it's the asset class. It's the right asset. It's the best asset class. It's that it performs better than any other during a recession. And so they're already sold on that. They like the idea of doing it actively, but then either work is taken off or they don't have the capital to do one on their own, or they haven't got to the level where they can raise their own capital, but they've got 50,000, 100,000 they can invest passively. They look at the IRR that we're offering and they think, you know what, those returns are pretty good. And that's probably close to what I would get on my first deal until I get really good at this, or I get the really good deals. That I think I'll put my money there, get a return on it, and I'll get some experience. I get to ride along with Scott, attend his quarterly webinars, see how this facility that I invest in works, and how he utilizes his best business practices. And that'll just, create more of an experiential knowledge for me when I get out and get ready to go do my own. And so we have a lot of folks that are looking to come along with us as passive investors that maybe thought they were going to do it actively. But quite honestly, in what I feel is really smart, they get one under their belt that way. So when they go to a lender and they get ready to ask for a loan on their own property, and the lender asks that question that we all dread, and when we're new, is, do you have experience in self-storage? They can now say, yeah, I'm a part owner, because it's true. They're an equity partner. They're a part owner in this facility, and they can speak the language. And we all know that immediately elevates them to another level in the lender's eyes. And so they build the resume along the way. They build their knowledge. They build their relationships, and they see who we're using as vendors, and they get a firsthand look of all our underwriting and due diligence, and they get to do all this with very little risk on their part, because they're just investing a small amount in a company that has done this over and over and over again. So those are the two main buckets, if you will, groups of people that are attracted to us and that invest in our projects.
That's very cool. So would you say that most of your raises are 506B raises?
They were in the beginning. And then we recognized that there's only so many folks that we have that are unaccredited that have capital to invest in our projects. And so we've gone to 506C because we recognize, even though we have a large database and group of folks, it may not pass, the Howey test of having an existing relationship. And so we went to 506C because we recognized that we could cast a wider net. And because I do speak to large and wide audiences, whether it be through on stage, literally speaking, or through our articles, our blogs, our podcast. And that way I can get that message out to a wider audience by way of a 506C, and then introduce them to our offerings immediately and directly that way. And so we get a little more traction through a 506C. And we're probably, we've had a healthy mix earlier in the beginning where we would trade back and forth just to make sure, just to know that we've got a lot of 506B folks that are unaccredited that want to come along, and we're due for another one soon. And I think we've got another project in the works right now that most likely will be a 506B, and we'll put that out to our list again, because we don't well, we certainly want to show some love to all our folks that just aren't at that level of being accredited yet. And we don't also want to lose them to, somebody else or another place to have them invest their money because they should be investing with us.
Right. That's awesome. So besides, attracting investors through your social media influence, your education side of the business, what would be another way that you are attracting investors that's working well for you?
Yeah, the podcast is one, and that's not necessarily social media, but it's another avenue that's very similar to that. And I think that's been about the best way. I think anybody that invests with you, not just you, Tim, but anybody on this call here. I mean, we go through a know, like, and trust campaign. In the beginning, it's friends and family because they already know you, they like you, and hopefully they trust you. If they're family, they should, and your friends. But beyond that, in order to have a relationship with you, you need to build that. And so, in a 506C, when you're just going out to the general public, they'll watch some videos that you've created, and they watch you from afar, or they see your prospectus. But a podcast, especially if they can find you on somebody else's podcast like this, or on your own, they get to spend enough time with you and watch your YouTube videos, see your mannerisms and how you answer questions, how you ask questions. And if you're, a little more open and transparent, they understand what it is that you do and what you're about, then that it shortens that time frame in which they feel like they do know you and that they like you and they trust you to be able to invest with you. So the podcast has been great, and when I do show up, different places at different live events, whether they watched our podcast, the video version or anything else that we put out, they just said, I feel like I know you, and they can have conversations from things that you said 2 years ago because you had the conversation with them because they were there, they were listening to it. So that has probably been the best avenue itself. In terms of other ways, yeah, it's kind of all the above. It's really just, it is, if you want to call it a shotgun approach, it's just what we do. I get asked to be a part of lots of different panels and discussions and stages, whether it's virtually or otherwise, and contribute by way of articles and things. And when I get to discuss our story, we're 100% open and transparent. There's a couple of mistakes that we've made along the way. Thankfully, it's only been a couple, and nobody's ever lost money with us, and we've never lost money. We certainly didn't make as much on one or two deals, in the 17 years that we've been doing this. But we're very open and honest about that and what we've learned from that, and also just how we live our life. We created a pretty cool business with self-storage, and not it's a simple, predictable business model that has allowed us to be able to raise our kids and spend time with them and go on the mission field and be off the grid for 6 weeks out of the year to go do whatever it is we want to do. And that's in addition to our vacations. That's just our mission work. And to have that time and freedom to, be intentional and doing the same and showing others how to do that. And it's been an incredible ride. It's an incredible business. And we'd love to share that with folks. And if that resonates with them, then usually they come alongside of us.
That's awesome. Yeah. And in terms of these sort of channels of marketing, I do see a common trend with yours. It's all education, whether you're on a podcast, you're hosting a podcast, you're doing blog posts, articles, you're always out there educating people. I like that a lot. That gives you much higher credibility and authority than someone who is out there doing marketing, right? So
right. We just get to be an ambassador for the industry that has treated us so well. And I guess our tenure also helps too. I mean, we've been at this for a long time. This will be our third recession. And so, to be able to speak, to new folks on, the front end, or just investing in general. And, a whole lot of folks that made a lot of money from 2010 and beyond have never been through a recession. So, we recognize that we're kind of shepherds of some of these folks to say, hey, we've been through two recessions in 2000 and in 2008. And here's what this one's different. They're all different, but we kind of know what to expect in certain areas. And that just helps to be able to, and I'm not talking about passive investors to make them feel comfortable. That's part of it. But I guess just in general, people that are investing in real estate and self-storage, to be able to share our experiences. It's just kind of fun that we're heading back into that time again to, I guess, share that, to be valued, for what the experiences that we have, and to be able to share that again and to give back is just, it's a good place to be.
Right. That's awesome. And then, so, can you share with us, since you've done multifamily before, you're a big proponent of self-storage, share with us the pros and cons of each of them, and why you chose self-storage over multifamily.
Sure. Multifamily, tenants, toilets, and trash. Self-storage, no tenants, no toilets, no trash. What's
the downside? Share with us the downside of self-storage versus multifamily.
Yeah. So here's, I'll speak more. I'm not trying to be a smart aleck, but here's, you think you hire a property manager, property management company, as I mentioned, they take care of, all the challenges and the issues. And that's what I thought when I got into it and listening to the gurus on the multifamily side as well. And at the end of the day, there's people living in your property and there's issues, that you deal with, and that's fine. It's business. And I get that. At the end of the day, the problems still, the big ones are the ones that always get back to you, because those are the bigger checks to fix them, or the bigger issues. And so even though you have managers or management companies in place, you still have to handle those issues. And a lot of those are just unforeseen and unknown. You can't always predict or budget for all of those, because it's people, they shoot each other in your apartments. And I mean, our apartments were not in bad neighborhoods, and there's people that are running, doing fireworks, and they're blowing their fingers off in your apartment, and then they're trying to sue you. And, you got pet issues, you got people, noise issues, you got dogs, there's just so many things that, every time you turn around, you got contractors that don't show up. You have to babysit them. Contractors that steal your materials or leaves things out, and other people steal the materials. There's just so many moving parts because there's more people involved all along the way. It's just more people. And I love people, don't get me wrong, but that just creates more babysitting. And that's, I felt like that's what I was, is just a professional, low paid babysitter, always having to just get up every day and get on people about what they had to do, what they should be doing, what they're supposed to be doing, and disciplining them, spanking them. And it got old. It just wasn't fun anymore, the more that we had. And so, I think everybody would agree that, we love rental real estate if it weren't for the tenants. And so I took that to heart, and I looked around, and when I got to storage, we realized that we don't have those issues. And, when you go to small claims court, they're not, we don't deal with eviction laws, which are designed to protect the tenant. We got lien laws, which are designed to protect the owner of the facility. There's no ifs, ands, or buts. You don't pay, we lock them out, and, we sell their stuff off, and we don't have to go to a court to deal with a judge or a jury or anybody else, it's where they live. And so you have to take care of them and provide for them, even though they're stealing from you and they destroyed your property. They live there. It's their home. No, it's not. It's not. And the way I was raised is, if, somebody doesn't pay you, that's stealing. And if you destroy somebody's property, then you didn't go home and your dad's going to give you a spanking. And so, in storage, it is the opposite. I'm charitable because we build houses and we give them away, but I'm not forced to be charitable like I was with, having to adhere to eviction laws. So the downside, to answer your question, Tim, we got over onto storage, is there's $1 million, $5 million buys a whole lot more units of self-storage. They're just less. You're buying metal boxes on concrete slabs, which is good. The one downside to that is that there's just more. And so from a logistics standpoint and a management standpoint, you just have to keep track of more payments. The good news is, most of it's automated. It's ACH. It's, they hook up a credit card, they hook up a debit card to begin with, or we have a kiosk. They can come in and pay. They don't have to come into contact with a manager or management company. We have unmanned facilities where people can rent a unit at a kiosk and pay each month, whether they, it hits their card or they come up and they actually physically put their card in each and every month. Our facilities are automated. They have locks that are wireless on the back side of the units, inside the unit, so that if on the 6th of the month they don't pay, the property management software automatically locks them down. And at all our facilities on the 6th of the month, if you listen, you'll hear all the clicks of all our self-storage facilities around the country, or people that didn't pay, and they're locked down and they can't get into their unit until they pay. And I don't have to do anything. Neither do my managers. They know. And if they can't get into their unit, then they have to pay. And if they don't pay the next month, it hits and they get another late fee. And if they ever want to get their stuff or see their stuff again, then they have to enter their debit card and not negotiate with us, but they have to pay for the back rent and their late fees. They don't get to talk to anybody or negotiate with anybody. You want your stuff, you pay. And if they don't, then it goes to auction after 60 days in some states or 90 days in another. Then we have the code to get into that unit, or our older facilities, we cut their lock off and, take our overlock off, and we have the right by law to sell their stuff off and then re-rent the unit. And sometimes we re-rent it to the person who bought that stuff until they're able to get it out. Or if they get it out, we move in the next person waiting in line, that day. So I don't know if the downside, you're talking about the downsides. The biggest risk, the biggest downside, it's interesting you asked that. It's a common question. And I took a poll for an article that I was writing for Inside Self Storage about just that. What is the worst thing that has ever happened to you, or what's the downside of self storage? And unilaterally across the board, everybody that I interviewed said, the downside or the worst thing is that I should have gotten into this business sooner. And, they weren't all in. They weren't all in, single family or apartments. It was just like, I wish I would have found this industry sooner. And then in our industry, the one, I guess the biggest liability is that if you sell the wrong unit in an auction. I mean, it's rare and it shouldn't happen. But if it does happen, there's nothing you can prove. You can't prove what was in there. It's your word against the client's. And of course, the client, will go in front of, and if it's a large amount they're asking for, it may go in front of a judge or a jury, and they'll say, well, my wedding dress and wedding album and gold bars and all this irreplaceable memorabilia that I had that's worth, over $1 million, and the trauma that it's caused me because you sold my wrong unit. And it's a mistake that if you sold unit 101 and it should have been 201, it's a simple mistake. However, it's not, because there's a process we have to go through, and it's almost impossible to make that mistake from what we have to do to adhere to the lien law. So that's like the biggest liability. The biggest downside, when you asked, as I mentioned, is literally just, there's just more to keep track of, but our software takes care of that. And it's not that big of an issue compared to tracking people down and then trying to evict them. The process is pretty simple.
What about forced appreciation through improvements and rent increases? Can you be as aggressive with that in the self-storage, or is there room to be
more so
with that? Really?
There is. Okay. Yeah, more so. Because first of all, our leases are 30 days. They're automatically renewing 30-day leases. So, I mean, technically you could raise rent every 30 days. Obviously, you're not going to have a whole lot of clients if you do that. But when we move typically when we buy a facility, what we find in many cases, which is music to my ears, is when we're walking around the facility doing a site tour with the owner, if we have that luxury, or the broker, the owner typically will say, well, how full are you? What's your occupancy? Well, we're 98% occupied. My goal is to always stay full. I haven't raised rates in 10 years. And I'm just like, really? Good for you. And I'm thinking, oh my gosh, you just threw a whole bunch, if not millions of dollars down the toilet, but good for you. Because that means that they're 20% below the rest of the market. And as soon as I move in, not 30 days after we move in, but 60 days after we move in, we send out the good news letter to all the clients. Good news. Hopefully you'll like the improvements that we've made. And as we did an independent audit of each and every unit, we found that you're 20% below what we're charging for people coming in the door right now, and 25% below the rest of the market. So we're going to raise you to here. It's still less than people coming off the street, and it's way less than the guy down the road. Just in case you're mad at us, you won't move down the road. And we're able to, in many instances, come in and raise rates 3%, 5%, as high as 18%. Across the board 60 days after we move in. And we're able to force the appreciation that way. In some cases, in one facility, $900,000 in value 60 days after we bought the facility by raising rates 18% in a Class C facility in a secondary market, which is why we like those. And then did it again 9 months later, not a year later, but 9 months later, because we were still, per what I just said, we're still below the rest of the market. And the rest of the market raised their rates. And so we raised ours again, still below them. And we increased the value by another $170,000. So almost $1 million, a little over $1 million in value, technically, within 1 year after purchasing this facility. And we purchased it for $2 million.
That's impressive.
So that's the best case scenario. It's one of our shining examples, but we're able to force the appreciation by way of rent growth, and we can do it very, assertively or aggressively if we want. But then if they didn't sell locks, boxes, and moving supplies, we can open up a small retail center in the office and sell locks, boxes, and moving supplies. Tenant insurance, renter's insurance. We get a 50% commission or a split on that if we sell that. eBay services for packing and shipping, or just selling things for them with a manager that's in the office if we have a facility with a manager in the office. Boats and RV parking, we can sometimes we have propane filling stations or a concierge service to get the thing ready for when folks pull up. Detailing services for boats and RVs as well. There's a number, just depending upon, where you're located. We'll do a feasibility study. Does it make sense to have record storage and shredding services? Temperature controlled is an option. However, that's really just kind of becoming commonplace. But if we take it to the next level with humidity controlled for, advanced record storage, or storing arts, furs, collectibles, wine storage, with different humidity controlled lockers and alarms and redundancy, there's a number of different ways that we can customize and add different ancillary income streams to a facility just based upon where it's located and what the market will bear. So yes, we can force the appreciation and the value through a number of ways.
That's awesome. That's really good to hear, because I'm looking at a 151 units. It's currently sitting on 3 acres, but it has another 5 acres to expand into. It's a C class.
Fantastic.
And yeah, it's 96% occupied. And I didn't think to ask, well, when's the last time you raised rent? So that's a really good one. So
yeah, well, awesome. If you haven't bought it yet, when your son buys it, he needs to do it in at least 30 to 60 days later, because when you're at 85% or above, it's time to raise rates.
Gotcha. That's good. I love that. You mentioned you've been through, 2 coming to 3 market cycles now. What challenges are you seeing in this market condition, and how are you navigating through that?
So in some instances, this is no different than the last 2, and that is in an interest rate environment that is very volatile. Then, banks are stepping back. They've got pencils down. Some of them, they're just not looking at things right now, or at least they're not telling us that they're not looking at things. They may make up a reason / excuse why they're not lending, or why they're saying no. LTVs, loan to value, is coming down, and some of the other stipulations, loan stips, are a little more cumbersome. They just want to cover themselves, and shorter time frames to be able to lock in terms of the rate, as well as amortization is coming down, where it may have been 30 or 25 years, depending upon the age and condition of the property. Now they're backing down 25 to 20. So those are some of the things that we're looking at, the challenges right now. I think also managing sellers' expectations, where they said, well, you know what? 7 months ago, my neighbor down the road, they got X number of dollars per square foot, at a 5 cap based on their net operating income. And, to persuade them / convince them, or have them come back down to reality to say, well, we're not in a 5% cap rate environment because interest rates are at 7. So we got to be buying at least 7, but, now 8 or 9%. And so managing sellers' expectations when they came to the market late, thinking that they can get, mid to earn, first quarter 2022 pricing to try to sell in fourth quarter 2022 with interest rates where they are. That's been one of the challenges. And so having to retrade some of the projects that we were already in the middle of, and go back to the seller and say, hey, if you want this number, you're going to have to hold some paper back and give us some terms, or lower the price, or we may have to walk away from this project. We've killed one project and put one on delayed. Didn't really have hardly any money at risk on those. Just disappointed that we couldn't make them work, but better than getting further down the road to recognize that these wouldn't work and either not make expectations, or worse for ourselves or our investors. So I think those are some of the main challenges right now. And then on the equity side, as we touched on in the beginning, is it's we can't raise capital at the same velocity, at the same speed that we did at the beginning of this year and for the past 5 to 6 to 7 years.
Gotcha. So in terms of capital raising, like you mentioned, you're not able to raise at the same velocity. And also too, I also hear fears from the passive investors, right, of where the market, what current market condition, where it's going. How are you overcoming that, addressing the fears, and still being able to raise, in the volume that you need? So the main story that we've been telling folks, Tim, is that let's look at where the inflation rate is right now. So what is stated publicly, and then what is real, whatever number you land on, whether it's 7%, 9%, or for those of you that are really digging in and understanding that it's 12 or 13% or higher, when you add everything back in that the government is not adding in, you recognize sitting on the sidelines is bad. If you're sitting in cash right now, not investing, well, then you're losing 9 to 13% on your money right now. And that's a real thing. I mean, that's real. Some people don't
I guess, recognize that. If you're not at least achieving, 9, 10, 12, 13%, then you're going backwards right now. And you're losing value. Your net worth is declining, every day that you sit and not do anything with it. And so when we then show them, hey, our fund right now is projected to earn 20 to 22%, and it's an 8% preferred return before the splits, you're at least getting an 8%. And, if we do what we say we're going to do, and by the way, our track record shows that, we've overachieved, our IRR over the past 15 years, our history is 34%. That's what we've returned to our investors. So we're double, any inflation rate out there. And so these are the reasons why you should put your money to work for us. So we've got the stats and the history behind us, and we're, just really showing them with logic and the reality of their situation and where we are in the market right now, the reasons why they need to be investing in something. If it's not us, folks, go find something you feel comfortable with and invest some money in it, but don't sit on the sidelines. So that's probably the primary reason. And then again, pointing back to self-storage, we're the most recession-resistant asset class in real estate. So if they're looking to invest in real estate, this is the asset class within real estate that makes the most sense. It performs better than any other during the recession right now. And again, we point back to all the stats, not only just historically of what we have, but everything from Green Street advisors to, Wall Street to article after article after article. We can show them how self-storage did through the last recession, as well as the one before that, and how it outpaced everything else. So at that point, once we show them our track record, the industry, it's really just a question of, do you qualify? Are you accredited, or they're just not going to do anything, and they're going to, wait for something better to come along. We've done our job, but we put ourselves in the best position by nature of what we've done and how we've operated over the past several years. And the fact that we're in self-storage, we've got the best story to tell out there right now.
Gotcha. That's awesome. I'm curious, what's your typical split for the LPs?
I don't want to say that we do things dramatically different than anybody else, but we reverse engineer everything back to an IRR. We recognize I'm in competition with you, Tim, because you've got folks that are looking at you. You've got folks that are looking at me hypothetically to invest, and they're going to look at your IRR, my IRR, anybody else that's on this call right now. And you have to have a general market IRR that is attractive to folks. So, that's where we need to be. If we've got a development project, there's a little more risk because, there's no historical financials to look back on. They can look back to my track record, but not on this project. And so for that, we're going to offer a higher IRR, which means a higher split and maybe a higher pref. If it's a facility that is, like the one that you're looking at, Tim, for your son, it's 150 units on 3 acres, and you got room to expand, and it's 94%. Your projections are going to look strong. And so that is, low risk, especially if you can show them for the past 5 years, here's where the occupancy has been. And this is kind of a low risk, venture for you to invest in. And so your IRR is in the mid-teens, 14, 15, 16, and maybe a lower pref and no pref at all. It just depends on what you're looking at. So we're always looking at the market, what is the going IRR, equity multiple, cash on cash return for existing projects, whether it's mobile home parks, assisted living, other self-storage investors, multifamily, and then development opportunities out there in the marketplace. And I'm going to try to match that. So what I do then is we say, well, what's a pref that I need to have in today's environment? Probably a 10 pref. I've seen some folks that are out at 16% pref right now. We don't need to go to that level. We're not going to go to that. Yeah, wow is right. I was shocked when I saw that. Folks, that's a little too high. I think that's an apology for lack of value or history that syndicator has. If you're offering 16%, it means you don't have much of a track record to go on, and you're trying to lure people in. But we're at a 10 right now, and then our IRR is right in that 20 to 21%. And that is, if our goal is we want to raise the capital quickly and get this closed out so we can buy that property if it's a syndication, or fill up that part of our fund so we can buy the next 2 or 3 properties coming down. So we engineer it that way that, I don't know, Tim, it's a 70-30 split. It's a 30-70 split. We don't want to leave too much on the table. It's a 27-63, whatever it looks like. Yeah. I'm always going to, our split is determined by the IRR that I want to put out on the street that is attractive, that is close or better than yours, so that I can raise the capital quickly. Does that make sense?
Yep, it does. It makes a lot of sense. So I assume then, in most cases, do you project between 18 to 20% IRR for your calculation?
Correct. Yeah, that's where we're at right
Okay.
now. And our pref right now is in that 8 to 10% range. And then, the equity multiple ends up, just shakes out to be above 2 typically. And our cash on cash, annually is, in that 6 to 8%, but it depends on the project. It may need a lot of heavy lifting on the front end. So we wait on the cash on cash till later.
That's good. That's good. So, I know you raised a lot of money, over $70 million. If someone, starting out, they might think like, gosh, that number is huge, right? What would you say to them? What would you share with them?
Who cares? What's the deal in front of you and how you're going to raise the capital? Don't look around to see what I've raised or Tim's raised or anybody else, for that matter. But I will say that, and at least feel bad about it or feel like you can't achieve it. All you need to raise is the 500 grand you need right now, or the million or 2 million you need right now. And what are the tools and resources you have and at your disposal to raise in the time you have? And if not, then how do you learn how to do that? Or how do you bring other folks in? And, can you be a fund of a fund? Can you bring partners in? What do you need to do to, get to that number until you're able to do it on your own, or whatever that is that you aspire to do? If you want to have $100 million fund, then what do you need to do to get there? No different than anything else, just one step at a time, one day at a time, looking at what you need to do and who is going to be able to help you to get to that place.
That's awesome. So what's your big passion right now? What's your goal or passion that you're, working hard on right now?
Let me tell you one thing that I just wrapped up. I'll answer that first. And that is, when for those that are here on the call, that you're at that place where you get to do some really cool stuff with the money that you have. And by cool, I mean by way of giving back. Our pastor just retired after 36 years in ministry, 23 at our church. And so you saw this maybe on Facebook. A couple of our staff put this out. So I had the opportunity. I'm an elder at our church and had the opportunity to be part of putting together a retirement package. And I said, oh, how cool would that be? He's got GTO stuff all over his office, and he had a GTO, a 1969 GTO when he was a kid. First date with his wife, went out in this car. And I said, how cool of a church would we be if part of our retirement package, we bought him a 1969 GTO? And everybody said, yeah, that'd be really cool. And then a year later, the CPAs and the accountants and the lawyers and everybody else said, yeah, we can't do that. And I said, well, all right. I love it when people tell me no, challenge accepted, game on. I'll do it on my own. And so I did. So I got together a group of folks in the church that donated. 2-year search. I found a Liberty Blue 1969 GTO like he had in high school. It was in a museum. It had been restored 15 years ago, and a guy bought it, never drove it, kept it in storage. And then he passed away, and his kids consigned it and sold it. And we bought it and then spent another $9,000 bringing it back to life and putting all the cool stuff on it and shining it up, making it look like new, and presented it to him on top of his retirement package, and blessed him in ways that for somebody, it's the proper way to honor somebody who has given their entire life to serving others, period. And it was cool to be in the position where I had the freedom to do that. I had the ability to go buy it myself and then raise the funds afterwards, because that's what we do, right? We're all syndicators. We all raise capital. And so I had the ability to rally a whole bunch of folks around this vision and this dream to make it happen for one of the most incredible individuals that's had a huge impact on my life. And so you get to do cool stuff like that when you get really good at what you do, from raising capital, and means getting people to come alongside of you and having the time and resources to be able to make stuff like that happen. So that was, I don't know, it was cool to be in a position to be able to be used like that and have the ability to do it. So what was your question again, Tim? I forgot.
No, it's perfect. So your big goal or big passion right now. So
yeah. So, the passion is, it truly is being on the mission field. There's just something, all your problems go away. There's no ultimatums. There's nothing when we're out in Mexico and we're building a house and I'm using my office hands to, put them around a hammer and build a house. And then after 2 days, be able to give the keys to somebody who would never have an opportunity to buy a house on their own, and to now stop having lung disease and issues because they've been living on a dirt floor all their life, and to have a place for their kids to do homework where they've never been able to, or even go to school because they didn't have a home to go to, and to end generational poverty one family at a time, and be able to pay for and take 25 people on every house build who and pay for them to have this experience, and with their kids to put their kids and them on a path of seeing what it's like to have an open hand, to be able to give back and to be a vessel for that, and to set them off, perhaps in some cases, on a lifetime of understanding what it's like to be able to be a servant and give and look at their business and life a little bit differently, and the ripple effect of that. It's pretty cool. And it's no pride and no pointing back to me, but it's just, there's something about it. And for those that have been, that are on this call, that have been a part of a mission trip or just serving of any sort, without pointing back to yourself, it just feels good to be used, to be able to use your gifts and your talents to help others. And so to have the opportunity to be able to do that at some point more than what I'm doing right now, that's what I'm passionate about. That's a good place to be.
I love it. Absolutely love it. All right. So if you can go back to, teach your younger self or share a lesson with your younger self, or even your kids right now, what would you teach them or teach yourself?
Yeah. I think, I don't know, those of us that are still type A and moving really, really fast and very competitive. I could have slowed down. I mean, we created a life that was fantastic to be able to raise our kids and do stuff. But I still think that there's times when I should have closed the laptop and just leaned in, or at least be more emotionally present with my kids when they walk in. If I'm working from home and they walk in and they say, "Hi, what's going on?" And I do one of these or something else. There's moments that I'd like to have back. There's not a lot, but there's some of those moments. And I think also, wanting to, just driving for the force of, or for the sake of driving, there's a number, there's a goal that I need to get to because it's more than that guy did. And it's better than this gal. And, I want to do this better. And instead of just, the greatest gift that I think you can give to your kids, to your point, Tim, and to yourself, is self-awareness. And just recognizing that, not a whole lot of that stuff really matters. How do I feel? How do I feel right now? And how I feel shouldn't be dependent on how I compare myself to others. And that's increasingly more and more difficult for us as adults and kids these days, when, we live in an age of social media transparency where everybody's being compared, whether they like it or not. You're comparing yourself, and you feel like you're being compared each and every day. So the lesson is, just stop it. What makes you feel good, understanding who you are, what you were meant to be, and what you were meant to do, and then just lean into that and turn off all the noise, stop comparing, and go do it. Because chances are it's probably something that is a greater good than what you're chasing right now, that makes you feel better and good about what you're doing, to be able to produce something in the world that you were, that God gave you the gifts and the talents to go do. So lean into that and go do that.
That's awesome. Love that. I love that. All right, Scott, for the folks listening, they want to connect with you, learn from you, partner with you, invest with you. Where would you like to send them?
Yeah, that all happens at selfstorageinvesting.com. Selfstorageinvesting.com. There's all kinds of free resources to be able to learn about self-storage and how to get into the business, and white papers and what's going on. And then if you Google Scott Meyers self-storage, you'll find me everywhere on social media, all places. Just really easy to find us. Scott Meyers self-storage on, wherever, Facebook, Instagram, LinkedIn, probably the best for the folks that are here on this call. We're all syndicators. That's where we all hang out at a professional level. So go connect with us there on LinkedIn. And some of the folks mentioned they're doing funds of a fund, and we don't have all the money we need ever, and we also have times where we have more money that we want to put to good use of our own, as well as our investors, so they don't go away. So that's the beauty of what you built here, Tim, is a community of folks that we can all help each other, because we're all at a different place in that balance of too much money, not enough deals, or too many deals, not enough money.
Yep. That's awesome. Thank you so much, Scott, for doing this interview with me today. Really appreciate you.